Hey, how we doing? Good day from sunny London, says Ray. Well, it's not so sunny here. Not so sunny here on the east coast of the U.S. today, but that's okay. We don't mind a little rain. Gotta rain sometime, right? And that's all right. We don't mind that. So here we go. Some really incredibly bad economic numbers and have just come out. I guess during Adam's session, you guys probably covered that. I'm sorry about the confusion earlier. I was on the schedule to be here an hour ago. That's why I was in the room. No disrespect intended toward Adam, who happens to be a friend of mine. Someone who, listen, Wall Street's kind of a small place. Adam and I have known each other I've probably met Adam about 8 years ago, and actually, hung out with Adam a little bit way back when. And even before that, we had a lot in common. We were both prop traders in the New York City area. And, Adam's a great guy. I highly recommend listening to Adam during those type of things. And, it's incredibly bad numbers today. You're not really seeing that much of a reaction out of the euro. If I put you can see right here on the 5-minute chart, there's a lot of volatility on that candle, because the truth is, the numbers are really bad, but nobody really knows how to trade it because everything is so manipulated now by central banks. The ultimate manipulator, of course, is the Fed, and everybody knows that, right? I wrote a book about that. So, that should be fairly obvious. And by the way, that's the book of the year from FX Street. It's called Selling America Short. You should definitely check it out because everything that I wrote in the book is coming true, much to my chagrin, I have to tell you. It's one of those books that you write and you hope that you're wrong, and then you're disappointed to find out that pretty much everything you wrote is correct and then some. So anyway, euro, not much reaction just yet. Still trading around 128.73. Getting some really odd private messages from somebody who I know really well under a pseudonym, right? Under a fake name. So might as well use your real name, bud. Okay, I know who you are. If you want to be weird some other time. Okay, I'm busy talking to people right now. Okay, let's get down to business here on euro. So market's really kind of confused about how to react to this, we'll take a look at the numbers. And there's a concept I want to introduce here called low man. All right, what does that mean? Well, when you look at these, and these are really bad numbers. When you look at these numbers, right, 1.3 on GDP. Now remember, you're looking for 1.7. This is not a volatile number, right? U.S. GDP is not volatile. Okay, and so that's a huge miss. Now you look at this durable goods numbers, and this looks like a worse miss, doesn't it? Negative 13.2, down 5. We're looking for down 5%. You get down negative 13.2. What you got to understand about durable goods is that it's a very volatile number, and it is very influenced by really kind of crazy things like huge orders for airplanes, right? So think of durable goods as anything that is that's built to last more than 2 years, right? So your washer and dryer are durable goods, but the clothes that you put into them are not. right? Because the clothes are less durable, but anything that's big and heavy and, made of metal is probably a durable good, like a car, an airplane, a dishwasher, things of that nature, right? And durable goods orders to drop 13.2. Now that is a hideous number, but this number is actually influenced a great deal. That's not the worst number that we got today. It's hideous, but it's not the worst number that we got today. Why? Because this was very skewed, in my opinion. And you don't see the X-Transportation order here. X-Transportation takes out cars and airplanes. And I think the X-Transportation, the number really wasn't that bad. I can't recall it off the top of my head here. But X-Transport, it really wasn't that bad. So the durable goods numbers actually isn't the worst one. The worst number here, the really ugly number here is GDP, because this is not volatile. And GDP, generally speaking, isn't going to miss estimates by 0.4% from one month to the next. What that's telling you, is it's not telling you that the economy is slowing down. It's telling you that the economy is falling off of a cliff. Okay? And that's really, really bad. Okay? And I think you have to wonder, you have to look at, children place blame, adults take responsibility. I think you have to look at this number and say that this number is a result of, what we've done. This is a result of our policies at the Fed and elsewhere, right? This is the result, and at some point, you're going to have to stop blaming things that happened a long time ago or whatever, and you have to start taking responsibility like adults and say that, wow, what we're doing isn't working. We have to do something else. In terms of Fed policy, I'm speaking specifically. I don't know how many of you caught Charles Plosser on Bloomberg about an hour ago, actually about 2 hours ago. And Plosser's a guy, he's the head of the Philly Fed, and he's a guy who gets it. He says, listen, it doesn't matter how much quantitative easing you pump into the system, it's just not going to work. Right? It's just not going to work. And of course, he is therefore, treated like an outcast. He is therefore, treated as he's crazy, because all the people who are in charge believe that this magic fairy dust unicorn policy is going to work. And clearly it's not working. Okay? And it's just a matter of, are people going to, have the courage to stand up and say, hey, this isn't working. All right? That's really the question. Okay. How come so just trying to get through all the weird posts of I'm not going to say your name out loud, okay? I knew it was you last time, and I'm trying to be kind. I think you sometimes misunderstand how kind I'm trying to be. When I actually, when I make believe that you actually have something to do with the markets. Okay. All right. Okay. Thank you, Maud. I appreciate that. Someone, Maud, you can probably see the comments. Someone decided exactly at the beginning of the session to bombard me with nonsense. And not only that, he's completely wrong. It's one thing to bombard me. If you want to call me out on things that I'm wrong about, do it. But this guy's always trying to call me out on things I don't even believe. Rob. Okay, Rob? All right. Let's get to the charts. Okay, so we do have some questions. Okay, we do have some questions here. How come Euro USD hasn't rallied here? Euro's been weak overall. There you go. Euro's been weak overall. Now you see that Euro's actually rallied a little bit off of this news. Generally speaking, really bad economic news, the dollar gets stronger. But the market really isn't sure how to react to this news because the market looks at it and says, well, maybe this means there's going to be more stimulus from the Fed. So for a long time, we sort of took the stance that bad news used to be bad and good news used to be good. Then it turns to a thing where good news is bad because it means less stimulus, and bad news is better because it means more stimulus. But I look at it this way, technically speaking, this is my chart. We have a bounce yesterday off of the 200-day moving average. That's in red here and you can see yesterday's low. All right, yesterday's low is 34. So we don't quite we get within maybe 10 pips of that 200-day moving average and we bounce up. And so, we get a nice 38.2 retracement is right about here around 127.50. And that comes exactly in line with this former resistance level back in June. So there's a lot of support in that area. And then you could also throw in there, if you measure from this low here, all right, another Fibonacci, you get a 38.2 retracement, all in that same area. All of these are coming in at around 127.50 to 127.35, And I think that's where we're heading. I think that's where we're heading next. This is a healthy pullback. But the thing is, a lot of people were kind of puzzled when they saw quantitative easing coming in because the stock market was on fire. And you're saying, well, the stock market's going up so much. How can we possibly have quantitative easing at that point? Well, this told the story. And if you're in the room here on a regular basis, you knew about this. All right, look at the high volume sell-off here, right, on oil. So oil, make that the hard right edge of the chart, right? Oil's going higher, 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 quantitative easing, everyone's happy, more stimulus. Boom. Look at the huge volume sell-off on oil in here. And, it's funny. On this first day, people were calling this it's a flash crash. It's a flash crash, right? But it's not a flash crash. It keeps going down, and we go lower still. And oil actually hits $88 a barrel. This is USO that you're looking at, by the way. This was the tell right here that something bad was coming. Because I want you to think of oil as an economic indicator. Okay, oil doesn't necessarily trade based on supply and demand. I mean, that's part of it. It's always part of it. But there's expectation as well. And somebody decided to sell a bunch of oil. Look at the volume. It's one of the few things, right? We do a lot of intermarket analysis here. And one of the things that we look at, right, we look at things like the price of oil, and we look at things like gold, and we look at the stock market, and we combine it with analysis of currencies. We combine these things together, and once we combine them together, we come up with this type of analysis. So we have a huge sell-off here, and then more here, and so it's a lot of volume involved, and that's generally a bad sign. That means it's a big seller, and somebody who's a committed seller is dumping oil. Now, why would you sell oil? Right? Well, think of it, again, like an economic indicator. In a strong economy, more oil is needed, right? So imagine like factories, right, are working harder. They're pumping out more things, like durable goods, for example, right? They're pumping out more stuff. They need more oil. But if the economy is going to slow down, you don't need as much oil. If people aren't going to work, they don't have to drive to work. You don't need as much oil. Right, so look at that. That was your tell. That was back on September 17th, and we've been talking about this pretty much ever since. And so there's clearly something wrong at that point And that's an indicator. So don't ignore these things, right? They're trying to tell you something. Did gold fall also? No. And it shouldn't, right? Gold did dip yesterday, but really this trend is still intact. Why isn't gold falling? Because the Fed can print money, but they're not going to print oil, right? And you think of gold as almost as a form of money that's undiluted, right? It's an undiluted form of money. You can't print it. But, you know, and therefore, the more money you print, the higher gold should go, right? So what's next, right? Oil starts falling on the 17th. The euro starts falling at what date? Makes a doji on the 17th and starts falling on the 18th. What's next? Stock market peaks when? On the 14th, but really holds its ground and starts falling a little bit on the 21st, but really not in any type of meaningful way until the 25th. So I think you'd have to say the stock market has a little bit of catching up to do as far as pulling down. But the thing is this, right? Much like gold, think of it this way. Companies print stocks. It's almost like a form of currency for each company, if you think about it. And, for example, right, when a company introduces more stock, it dilutes the outstanding shares. And that makes the stock worth less. That's one reason why I've been advising people against buying Facebook. Facebook's going to dump more shares on the market. And you probably saw me speaking about this at length on CNBC, you know, where I'm a frequent guest these days. All right. Just turn off the camera here momentarily. So Jack says, USA slowdown. Ray says you both work for the same broker. That's right. Yeah, Adam's a great guy. I know him personally. I've hung out with him. I've had beers with him. He's a great guy. USA slowdown? Yeah. I mean, you know, over a cliff, basically. How come Euro USD hasn't rallied after the bad news? Well, again, because central bank planning has this market all distorted now. They don't really know how to react to anything. Bad news is good because it means more quantitative easing. Bernanke shouldn't Bernanke be not dealing with unemployment? Yeah, absolutely. I mean, listen, double mandate is a contradiction. For example, right, the Fed has two mandates, right? They've got to keep inflation down, but they got to keep employment up. How do you keep employment up? By raising inflation. You know, their two mandates are diametrically opposed, and they should not have a dual mandate. One of those mandates needs to go away. They should not deal with employment, Vince. Absolutely correct. Isn't there a Labor Department that deals with that? Yeah, you would think, right? You would think so. Okay. Probably not premium guy. Well, depends what you consider a premium guy there, Boyke. So when they admit all stimulus not working, stock market should fall. Well, even Bernanke has admitted that quantitative easing has diminishing returns. In other words, it doesn't cure everything. It's like, for example, you know, if a person is sick, right? You know, obviously the doctor tries to cure the person, but sometimes there's a misdiagnosis. And a misdiagnosis can mean that you're treating the wrong thing and can actually make things worse. And that's really the situation here, in my opinion. You know, Bernanke's decided he's just going to keep doing the same thing, but in reality, it's just obviously it's not working for anyone who's paying attention. You know, it's just not working. Okay. So when they admit all stimulus is not working, stock market should fall. Actually, what needs to happen, Strat, is we have to, you know, face up to reality. If we can face up to reality, then the stock market, yeah, would fall. But we're not very adult-like. We're much more childlike these days. But if we were to act like adults and face up to reality, yes, there would be a big change in prices, but then we could start to fix things for reals instead of this phony unicorn-like repair. So we had QE1 twist. Remember twist when you were young? Now QE3 infinitive. What's the solution? Well, it doesn't work. And the solution is that the Fed doesn't have the solution. The Fed doesn't have the answers. Right. Well, okay. So how long does it take for the Fed to stop stimulus? The Fed will never stop stimulus as long as Bernanke's in charge. The Fed has said that they will keep this going indefinitely. Right? They're just going to continue to do this indefinitely because they've decided that, that you see, first of all, in order to do the right thing, you have to admit that you're wrong, and the Fed cannot admit that they're wrong. So, because this is Bernanke's legacy, this is how history will remember him. So, Bernanke doesn't want to be remembered as somebody who did the wrong thing for 5 years and then admitted, oh, I'm wrong. Let's do the right thing. No, he wants to be remembered as someone who was right all along, but it was just circumstances, right, that were preventing him from winning and from fixing things. But the truth is, he is wrong. And but it's very hard sometimes for people to admit that they're wrong. We know this is human behavior, and we know this is traders. It's very hard for people to admit when they're incorrect. And because of that, that's why we're kind of stuck where we are. Bernanke's not an elected official; he's appointed, and so he's not going anywhere. All right. Okay. Yeah, it's a very sick situation. All right, but we get used to those. Okay. This is the reality that we deal with, folks. So the thing is, even knowing these things, you have to look at these things and say, well, this is the game you signed up to play. All right? 163, right? And 163 being resistance here. And on this is on British pound, right? And we'll probably test this again. It's a general area near 163. That's kind of a big area. Move that up. That belongs really right up about here. Depends if you want to use the wicks or not. If you're going to use the wick, call the wicks into play, it's really 163, almost exactly. Right? 163 and 163.01 as a high and 163.08 as a high. And very briefly, right, obviously could not close above 163, got hammered back down. There's clearly selling pressure at 163 on cable, so I'd look out there. That might be an interesting sell point. Dollar Canada. Dollar Canada, looking at this one. This is another one. This is a downtrend, right, but it's been rallying. It begins to look like maybe, and it's like, if I cut through the wicks and stuff, I get to here. But if you look at this also in terms of, I like to use moving averages quite a bit, right? Yeah, talk about inappropriate. Listen, if you want to attack me under your real name, which I already know what it is, right? And the links that you're posting me in private, post them in public. If you really want to, if you really want to man up and come after me, do it like a man. Don't do it when I'm trying to settle down and talk to 50 people and throw a bunch of BS at me. That's wrong. Right? And once again, as usual, calling me out for stuff I don't even believe. So, I don't know what your twisted world is, man. I don't get it. All right. Okay. This one, to me, I look at this as a potential short on Dollar Canada. The trend is down. This could have some room on the upside. Not much help from moving averages on this one. But I do look at this in terms of, I'm looking at it in terms of on the daily chart. I'm looking at relative strength. All right. This says it's not overbought yet, and it's not up to the trend line. I love this trend line here. So relative strength says we're not overbought on a daily, and so it has room to run. Trend line says it's not really ready to hit resistance yet. There's really not a lot of resistance here. You see how this comes down? It's not really, when prices move fairly dramatically in one direction, then they don't really create support and resistance. We're seeing the same problem with euro, right? Once this thing popped, you see how it's kind of a straight line? There's no real resistance levels. There's no real, you know what I mean? As it comes back, there's no real support. There's no real resistance. That's why it's come down so easily, and I'm thinking it has a chance to come a little bit lower. Euro is not just down against the dollar today. It's important to understand. Euro's down against the pound. Euro's down against Aussie. And I really want you to understand what's going on with Europe is, a lot of people thought that this thing was solved. A lot of people thought this thing was solved earlier, right? When they come up with when you come up with the ESM, right, which is the big bazooka that they talk about. Okay, the ESM is the European Stability Mechanism. The German Constitution says that's okay, that's legal. But you know what? It's an empty bazooka unless there's something in it. You have to fill it with ammunition. The ammunition is money. The money comes from Germany, the Netherlands, Finland, countries like that. And you know how things are in Europe. It's always an ongoing negotiation. Spain doesn't want to ask for help because right now the yields on the bonds are low. And there's an election coming up. So they want to, it's not a politically popular thing to do, to ask for help. So they want to try to drag it out, try to push it back a little bit, but now the yields are starting to pop up again. The Spanish 10-year is up to 6%. Right? So, there's a lot of problems still in Europe. Did you see the retail sales number in Italy yesterday? It was awful, down 3.2% year over year. So this is why you're seeing that, euro is not gaining any traction. It's not just against the dollar. It's really not gaining any traction against anything. And I don't think you're going to see any support on this down until you get to 127.50. I already showed you that chart earlier. Okay. Okay. So anyway, it's about 9:30. We're going into, I'm sorry I was distracted, but, during the session, and I apologize for that. I'll even run a few minutes longer if there's nobody up behind me. But it's really kind of disappointing. People are nice to your face, and then just absolutely. I don't mind being called out, like I said, for things I believe, but you want to call me out for things I don't believe, it's just ridiculous. You want to do it under an assumed name and think I don't know that it's you when I've seen you call me out under this assumed name before in the past, then you're wrong. And anyway, have a good day, Rob. Have a good day, everyone. Take care.